Hello again, everybody. It is Monday morning, September the 20th, 2021. I'm Kosar of Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts, data series, and models to watch for the upcoming week that we think are likely to be the most influential for certainly the rest of this week and possibly into the next quarter. Number 1, know your levels. The S&P 500 finally breaks tactical support. And here's the chart. This is the S&P 500 going back to January, and it shows nine tests of the 50-day moving average since then. That final test, number 9, took place for the 5 days of last week. And then we opened much lower this morning. I'm looking up at my screen. The S&P is down 70. It's about 10 o'clock in the morning here in Chicago. And this shows you where your support is. So the first support, or the primary tactical support, was the 50-day moving average. That's currently at 44.36. That now becomes resistance, and that would also fill that little gap that we've made here this morning. So our support is at 43.73, and you can see we're kind of straddling it now and testing that. If we break that, the next level is all the way down here at 42.38, and that would be about 4.5% underneath Friday's close. And then finally, major support is at the 200-day moving average here at 41.06, and that would equate to a 7.4% move down from Friday's close, or about a 10% move from the top here that we made on September 2nd. So the point is, we could easily go down to the 200-day moving average here, and it would only be a 10% correction. So there's plenty of room for the market to go lower. So we like to keep our clients focused on those levels, and we will put charts like this out very frequently now that it appears that we're rolling into a correction. Just so you know how far the market could go, because once you do this, it tends to be like steps. You break this step, you fall to the next step. You break that step, you fall to the next one. Number 2, market internals. The Asbury 6 is negative as of September the 14th, which was just about a week ago. The Asbury 6 is one of 2 in-house tactical models that we have built to let us know when the market is starting to weaken internally. Just because the movement of the S&P 500, especially recently over the past several years, it could really be deceptive. The S&P is up 50 one day, it's down 50 the next. So what we've done with the 6 is we've back tested a lot of different indicator sets together. And this particular set tested well, and they're very diverse. The rate of change in the S&P here that I'm pointing to is actually the only one of the 6 that has to do with the price of the S&P 500 or the price of any index or individual stock. All the other 5 are what I'd call secondary indicators. They're relative performance between assets, investor asset flows, corporate bond spreads, volume, and market breadth. So 4 or more, I should say, that are either green for positive or red for negative indicate a directional signal. So you can see right now we're 3 and 3, 3 red and 3 green as of Friday, but we retain the signal from the 14th, in which 5 of the 6 were red, and really gave us a heads up in terms of the weakness we're seeing this morning. So 4 would have to turn back to green in order to turn the metric back to the model, I should say, to turn the Asbury 6 back to positive. In each of these cells is the actual date that that particular constituent moved to positive or negative. Volatility, the VIX. Is this a tactical market bottom? The VIX has been really not an important indicator to us up until this morning. and here's why. You see, the VIX has been in this kind of 16, 17, 18 range for some time and not doing anything. This morning, the big drop in the S&P 500 caused a spike in the VIX. Now we're testing 24. So now we've got a level that means something to us. On August 19th, July 19th, and June the 21st, those were all times where the VIX got up to that 24 area or very close to it. All of those were bottoms. These actually all, if my memory serves, these are all tested the 50-day moving average as well. So here, we're right back there, and we're actually a little bit up above 24. So that means, in terms of the VIX as we see it, either this is another bottom, or this is a change in the trend of the VIX, where we're now going to see a sustained move of higher volatility. That's kind of what it's leaning towards here. So the longer we stay up above the 24 level here this week in the VIX, it's going to suggest to us that we're entering a trend change in terms of the VIX, in terms of volatility, and we might see some more elevated volatility for a while, and that would be negative for the market. Number 4, investor asset flows. Watch the market leading QQQ, which is obviously the ETF that follows the NASDAQ 100 or the NDX. So we see it here. We've got NDX here up on top since April, daily chart, and down underneath we've got the daily total net assets invested in the Qs, along with their 21-day moving average. Why the 21-day? 21 days is Asbury Research's tactical time period. So what you can see here underneath is that when the Qs dropped underneath the 21-day moving average between April 30th and May 21st, it coincided with this dip in the NDX that we had. On May the 24th, these assets got back up above the 21-day moving average, indicate a monthly trend of expansion. And it was tested 3 times, June 3rd, July 19th, and then actually kind of a double here, August 11th and 18th. You can see all 3 of those, the assets started to expand again, and so did the trend higher. So we left the session on Friday sitting right on top of the 21-day moving average again. We're not going to see these data until early tomorrow morning, but if these assets actually break through the 21-day moving average, then it's going to be more confirmation to us that we're going with some kind of a corrective period, especially when it applies to the NASDAQ 100, because the NASDAQ 100 has been one of the only consistent leaders that's been outperforming the S&P 500 for the past 2 or 3 months. So if we lose NDX, that leaves us with even less leadership, and that would be more conducive to a deeper decline in the S&P 500. So we're going to be watching this very closely, and we're going to be putting out a lot of charts of this metric to our clients over the next week or so. Finally, number 5, seasonality. The worst of September is coming. Seasonality hasn't had the influence on markets over these past few years as it has in the past, but we still like to watch it here at Asbury Research because we think when it has some weight, when it has some influence, is when the market is already leaning towards the seasonality. So what we see here is a quarterly chart of third quarter seasonality from 1957 all the way through last year. And what it shows is that the month of September has 3 of the 5 weakest months of the entire quarter. You can see July starts out here very strong. The first 2 weeks of the quarter, all these are weeks, by the way. These are the 13 weeks of the third quarter, data going back to 57. So the quarter starts out very strong. It ends very weak. And the last week of September is by far the weakest week of the entire third quarter. Not shown here is that the weakest week of the fourth quarter, which is right around the corner, is the last week of October. So we still have some weakness here that could take us another 3 to 5 weeks. So you add all this up, and it looks like we're going to have a rough end of the month. Again, a lot of these indicators, I'm waiting to see what happens over the next day or two, particularly with the Qs. and with the VIX, and watching how the S&P 500 responds to these underlying support levels to try to figure out how much deeper, how much more severe this emerging correction is going to be. If you like our approach to markets, feel free to visit us at www.asburyresearch.com, and you could sign up for our free bi-weekly newsletter in which we talk about various aspects of the market from Asbury Research and how we're managing portfolios at Asbury Investment Management. Thanks for watching, and we will see you at the next one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.